Welcome back to Money Mavericks by James Chi, your fortnightly download on real estate, finance, mortgages, accounting, and tax in Australia. As we pass the halfway mark of winter and enter the new financial year, signs of movement, some subtle, others seismic, are emerging across Australia's economic and property landscape. The Reserve Bank's latest announcement delivered a surprise to what many in the market had anticipated, a hold on rates, but a softening in language that hints at potential cuts to come. The shift has already begun to stir confidence in certain corners of the market, with housing values accelerating nationally, even as winter chills keep listing activity subdued. In this edition, we explore how long-term supply trends are slowly improving and why the New South Wales government's push to reshape commercial property rules may have broader implications than most realise. Confidence is also holding firm among borrowers, with new research confirming that trust in mortgage brokers remains high, a nod to the value of tailored advice in an increasing complex lending environment. For business owners, we can take a closer look at the advantages of low-doc loans and whether used equipment finance still delivers ROI in today's economic climate. But not everything is an upward trend. A leaked Treasury paper has ignited fresh discussions about the sustainability of Australia's tax mix and the feasibility of the government's housing targets. These aren't just Canberra debates, they affect every household, business, and investor. In response, we unpack the leaks, implications, and the growing likelihood of broader tax reform. Meanwhile, the ATO's patience is wearing thin, and businesses with outstanding debts are starting to feel the heat. If you've been putting off a conversation with the tax office, now's the time to act. And finally, we take you inside the growing field of forensic accounting, once reserved for high-stakes investigations, now an essential tool in business risk management and litigation strategy. Whether you're navigating property markets, managing your business finances, or thinking about your position in the big picture, this edition of Money Mavericks is here to inform, challenge, and empower. Let's dive in. RBA update effective July 9, 2025. The Reserve Bank of Australia has held the official cash rate steady at 3.85%, defying widespread expectations of a cut. This marks a cautious pause after two earlier cuts in February and May. Why the hold? Despite easing inflation and slowing growth, the RBA board opted to wait for more data before making another move. In its statement, the board noted it wanted a little more information to confirm that inflation remains on track to reach 2.5% on a sustainable basis. Notably, the decision wasn't unanimous. 6 members voted to hold, while 3 supported a cut. Mortgage holders hoping for relief will need to wait at least another month. Meanwhile, despite growing cost of living concerns, many Australians are still choosing to maintain high repayments to get ahead on their loans. Looking ahead, several factors are expected to shape the housing market for the remainder of the year. On the positive side, interest rates are forecast to fall further, possibly to the early 3 or even high 2% range by the year's end, which should improve consumer sentiment and borrowing capacity. However, affordability constraints, elevated household debt, and a cautious lending environment may temper growth. If you have any concerns with your current home loan, reach out for a confidential discussion. The RBA's next meeting will be announced on Tuesday, August 12. Mortgages and Finance by Ding Financial. Trust in mortgage brokers remains high. Despite elevated interest rates causing stress to borrowers, trust in brokers remains high. According to the Consumer Access to Mortgages 2025 report, produced in partnership with the Finance Brokers Association of Australia, nearly 60% of borrowers will roll off fixed-rate loans in the next 12 months, potentially increasing financial pressure. The report reveals a significant contrast between financial strain and consumer confidence in brokers, with 82% of borrowers expressing trust in mortgage brokers compared to much lower confidence in bank staff. First home buyers are particularly reliant on broker services, with 43% of future first home buyers planning to use a broker when entering the market. FBAA Managing Director Peter White, AM, said it was an evolving landscape for brokers amid economic changes. While brokers remain the preferred channel for many, shifting economic conditions and digital disruption are reshaping how borrowers think about their next home loan, Mr. White said. The impending fixed-rate expiries present both challenges and opportunities in the property market. The report indicates that 57% of mortgage holders will transition from fixed to variable loans within the year, with many facing significant increases in repayment amounts. Despite financial pressures, refinancing activity is increasing. 16% of borrowers have already refinanced their loans, while nearly half are actively considering this option to manage their financial situation. Many households experiencing mortgage stress are still considering property investments or strategic moves rather than completely withdrawing from the market. The report highlights a significant knowledge gap about broker services, with 40% of consumers not fully understanding what mortgage brokers do. Nearly half incorrectly believe that they will be charged fees for broker services. This presents an educational opportunity for real estate professionals to provide value by clarifying the role of brokers and introducing trusted financial partners to their clients. Trust has also become a critical factor in consumer decision-making, with 39% of borrowers expressing complete trust in their broker compared to just 20% for bank employees. As interest rates remain elevated and economic pressures continue, the relationship between financial services and real estate is becoming increasingly intertwined, with consumers seeking trusted advisors to navigate complex financial decisions. 5 advantages of a low-doc business loan. For many small business owners and self-employed Australians, accessing traditional business finance can be frustrating, especially if your paperwork isn't up to date. Whether you're newly self-employed, operating a seasonal business, or simply haven't lodged your latest tax return, you may not meet the criteria set by major lenders. That's where low-doc business loans come in. Designed to improve funding without the usual paperwork, low-doc loans are assessed using alternative forms of documentation, like bank statements, BAS, or an accountant's letter. They can be a lifeline for entrepreneurs who need quick access to capital without the red tape. Here are 5 advantages of low-doc business loans that make them a valuable option for many business owners. Reason 1. Easier access to funds when financials aren't available. Low-doc loans are a practical solution when tax returns or full financial statements aren't available. Instead, lenders can assess your application using other documents like recent bank statements or BAS. This flexibility opens up funding opportunities for business owners who would otherwise be knocked back by mainstream lenders. Reason 2. Faster approval turnaround. With fewer hoops to jump through, the approval process is often faster than standard loans. If timing is critical, say you need to purchase equipment, pay a supplier, or grab a short-term opportunity, a low-doc loan can help you act quickly and keep your business moving. Reason 3. Flexible lending criteria. Low-doc loans are built for borrowers with non-traditional income structures. Lenders assess your financial position based on current cash flow and business activity, rather than solely relying on tax returns. This makes it easier for businesses with seasonal income, recent startup status, or variable earnings to qualify. Reason 4. Preserves working capital. By using a loan instead of your own funds, you can protect your working capital for day-to-day operations. A low-doc loan can be used to fund expansion, buy stock, or invest in marketing, allowing you to maintain liquidity while still pushing your business forward. And lastly, reason 5, tailored for self-employed borrowers. Specialist low-doc lenders tend to take a more hands-on approach. They understand the realities of self-employment and often offer repayment structures designed to match your income cycle. This personalized approach makes it easier to stay on top of your loan and reduce financial stress. If your business doesn't fit the mold of a traditional borrower, a low-doc loan might be a smart alternative. With the right lender and documentation, it's possible to access the funding you need on terms that work for your business. Talk to us at Ding Financial to find out more. Is finance worth it for used equipment? When it comes to investing in equipment, buying brand new isn't always necessary or financially practical. Many businesses are turning to used equipment as a cost-effective way to upgrade operations, especially when budgets are tight or immediate delivery is critical. But is financing second-hand machinery the right move for your business? Save capital and stretch your budget. Used equipment is often significantly cheaper than new, which means financing a second-hand asset can stretch your budget further. For businesses needing to upgrade or expand without tying up large amounts of capital, used equipment finance offers a more affordable pathway. Monthly repayments are typically lower, and the return on investment can be seen faster. Faster access, less depreciation. Second-hand assets are usually available for immediate delivery, with no waiting on manufacturing or shipping delays. Plus, since the equipment has already depreciated, you won't be hit with the sharp value drop-off that often comes with new purchases. This makes financing used gear particularly appealing for short-term projects or growing businesses that value flexibility. But consider the risks. Used equipment may come with hidden wear and tear, shorter lifespans, or outdated features. Some lenders may also apply stricter criteria or shorter loan terms due to the perceived higher risk. It's essential to factor in the asset's condition, resale value, and expected lifespan before committing. Whether it's new or used, reach out to Ding Financial for a confidential discussion, and we can help you compare your options. Real estate by Local Knowledge Property Group. Housing values accelerate as interest rates fall. Australian housing values are gaining momentum, with falling interest rates driving renewed growth in the property market. According to the latest Cotality, previously called Logic, Home Value Index, national dwelling values rose 0.6% in June, marking the fifth consecutive month of growth. The June quarter saw values increase by 1.4%, up from 0.9% in the first quarter of the year. Cotality's research director, Tim Lawless, said the February rate cut was a clear turning point for the market. The first rate cut in February was a clear turning point for housing value trends, Mr. Lawless said. An additional cut in May and growing certainty for more cuts later in the year have further fueled positive housing sentiment, pushing values higher. Despite the upward trend, current growth remains modest compared to previous cycles. The quarterly growth rate of 1.4% is significantly lower than the 3.3% peak recorded in mid-2023 and the extreme 8.1% quarterly peak during the height of the pandemic. The housing rebound is occurring despite relatively low sales activity, with housing turnover through the first half of the year tracking at an annualized pace of 4.9%, slightly below the decade average of 5.1%. Advertised stock levels remain tight, tracking 5.8% below the same time last year and 16.7% below the previous 5-year average, creating a more balanced market for buyers and sellers. Across individual capital cities, Darwin led quarterly growth at 4.9%, with dwelling values reaching a new record high, finally surpassing the mining boom peak recorded in May 2014. Perth and Brisbane followed with quarterly growth of 2.1% and 2% respectively. The rental market has shown a notable slowdown, with the national rental index rising just 1.3% through the June quarter, the lowest Q2 change since 2020. Annual rental growth has eased to 3.4%, down from a peak of 9.7% in November 2021. Mr. Lawless put this down to affordability constraints despite consistently low vacancy rates. Rental affordability is a key factor keeping a lid on rental growth, he said. Assuming the median rent and median household income, rental households are now dedicating around 1/3 of their pre-tax income to paying rent. Looking ahead, several factors are expected to shape the housing market for the remainder of the year. On the positive side, interest rates are forecast to fall further, possibly to the early 3% or even high 2% range by year's end, which should improve consumer sentiment and borrowing capacity. However, affordability constraints, elevated household debt levels, and a cautious lending environment may temper growth. Winter slows listings, but long-term supply shows signs of growth. Residential property listings across Australia dropped sharply in June 2025 as winter's seasonal lull took hold. According to SQM research, total listings fell 8.8% over the month to 234,067 properties. While activity slowed month on month, overall supply remains marginally higher than this time last year, up 1% compared to June 2024, suggesting a gradual easing of longer-term market pressure. Melbourne saw the largest monthly fall at 12%, down to 36,838 listings, slightly lower than June 2024. Sydney followed with a 10.3% drop, but its 31,489 total listings were still 6.7% higher than a year ago, indicating a modest build-up in housing supply. Brisbane listings fell 7.3% over the month and are now 3.5% lower than last year. Perth stood out as the strongest performer year on year, with listings up 23.5% despite a 9.7% monthly decline. Canberra and Adelaide also showed solid annual gains, while Darwin bucked the trend with a steep 32.7% drop in listings compared to 2024. New South Wales government set to reshape the commercial property landscape. The New South Wales government has earmarked $30.8 billion for infrastructure investment aimed at creating new business hubs beyond traditional CBDs. According to Ray White Group Head of Research Vanessa Rader, the substantial infrastructure commitment outlined in the recent budget will establish new commercial nodes throughout Western Sydney, changing how and where commercial development occurs. The government is actively repositioning commercial value away from the traditional business centres, Ms. Rader said. Transport investment, health and education infrastructure, and innovation precincts will redefine where and how commercial property is developed. The investment includes a $5.5 billion roads package and a $123.6 million for Aerotropolis development, which will redirect commercial demand towards transport-oriented and mixed-use precincts across the region. Innovation and technology sectors receive significant attention, with $79.2 million allocated for an innovation blueprint and $38.5 million for the Tech Central Hub, designed to attract knowledge-based industries requiring flexible, technology-enabled spaces. A newly established Investment Delivery Authority will expedite non-residential projects valued over $1 billion, potentially unlocking up to $50 billion in commercial investment annually. Perhaps the most innovative measure is the $1 billion pre-sale finance guarantee, the first of its kind in Australia. The scheme will see the state government pre-sales on up to 5,000 apartments, helping developers secure financing to build an estimated 15,000 homes across a 5-year period. Treasurer Daniel Mookie described the guarantee as a canny use of our state's balance sheet, designed to overcome feasibility challenges that have stalled construction projects throughout New South Wales. Industry can spend less time and resources having to convince their banks that there are buyers of these apartments and more time building them, Mr. Mookie said. Ms. Rader said it was increasingly important to have creative and mixed-use commercial formats supported by $586.2 million in creative economy funding. The pre-sale guarantee also has potential to activate integrated developments that combine residential and commercial spaces. The budget further commits $12.4 billion to health infrastructure and $10.4 billion to educational facilities, which are expected to generate stable commercial demand near new precincts in Bankstown, Westmead, Rouse Hill and Wollongong. These growth initiatives come alongside a $9.4 billion reduction in state debt, enhancing fiscal confidence for long-term investors. Treasury now projects a return to budget surplus by 2027-28, though the Treasurer cautioned that, quote, a lot needs to go right for us. Accounting, tax and business by local knowledge. Tax reform and housing targets. What the Treasury leak really means for Australians. A leaked Treasury document recently made headlines revealing internal advice to the Albanese government that suggests significant tax reform may be necessary to address Australia's growing budget pressures. The advice, which also references a reassessment of ambitious housing targets, signals a pivot in federal economic strategy, and it's stirring public debate across industries. According to the leak, Treasury recommends re-evaluating the balance between spending and revenue by considering long-avoided conversations about tax system reform. While the advice doesn't detail a specific roadmap, it raises possibility like expanding the GST, tightening concessions on superannuation and investment properties, and introducing new forms of wealth taxation. What does this mean for the average Australian business, homeowner, and investor? For one, it could spell the beginning of a broader policy shift, one that brings an end to the decades-long reluctance by both major parties to confront Australia's structural deficit. More importantly, it reflects a growing tension between funding essential public services and the constraints on the current tax mix. On the housing front, the leak notes that federal housing targets may need a quote readjustment. This is not just a question of supply chain logistics or construction industry capacity. It's also about the fiscal space required to subsidise affordable housing at scale. If funding for housing initiatives becomes tied to revenue reform, we could see a more integrated policies linking tax settings with property market outcomes. The implications are broad. Investors may face changes to negative gearing or capital gains tax concessions. Homeowners could see shifts in stamp duty versus land tax dynamics, especially if states follow suit with Treasury's reform appetite. Businesses may eventually see adjustments to company tax arrangements, particularly for larger entities. Although the leak does not represent government policy yet, it's a timely reminder that economic pressures are mounting. Australia can't rely on bracket creep and population growth alone to fund future commitments. For readers and listeners, the key takeaway is this. These aren't just abstract policy discussions. Whether you own a home, run a business, or manage investments, the national budget's future is your future too. Tax debts, expect the ATO to come knocking. The Australian Taxation Office is no longer being patient. After several years of pandemic-induced leniency, the ATO has turned a corner in its collection efforts. According to recent figures, over $50 billion in collectible tax debts remain outstanding, many of them from SMEs. With political pressure mounting and revenue needs increasing, the ATO has sharpened its tools. Debt recovery activity is up, default letters are more frequent, and the use of director penalty notices is growing. Businesses that assumed that they could fly under the radar are learning the hard way that the ATO's radar has been recalibrated. What's changed? While the ATO previously focused on education and leniency, particularly during COVID, the pendulum has swung. The tax office is now actively pursuing age debts, contacting directors directly in cases of unpaid PAYG, GST or super, and disclosing debts to credit bureaus for companies with liabilities over $100,000. The message is clear. If you owe money to the ATO, they want it back, and soon. But the approach isn't purely punitive. The ATO continues to offer payment plans and hardship concessions where appropriate. The key is communication. Ignoring ATO correspondence or delaying action is no longer a viable strategy. Who's most at risk? SMEs in hospitality, construction and retail, many of which carry tax debts as a legacy of COVID shutdowns. Companies with poor bookkeeping or delayed lodgements, which can compound penalties and interest. Directors unaware of DPN rules, risking personal liability for corporate tax debts. For individual taxpayers, especially sole traders and high-income earners with complex deductions, the ATO is also increasing data matching and audit activity. Real estate transactions, crypto trades, and share sales are squarely in focus. What should you do? Review your lodgements and ensure all BAS and tax returns are up to date. Engage a professional to assess your position and negotiate with the ATO if needed. Don't delay correspondence. Proactivity can often mean the difference between a manageable plan and an aggressive recovery. In short, the era of tax leniency is over. It's time for businesses and individuals alike to get their tax house in order. Why forensic accounting is more relevant than ever. Forensic accounting might conjure up images of criminal trials and white-collar crime documentaries, but its real-world applications are becoming increasingly relevant to Australian businesses and legal practitioners. At its core, forensic accounting is the use of accounting, auditing, and investigative skills to examine financial records and uncover the truth. It's where the sharp edges of law and finance meets. Where does it matter? Firstly, litigation support. Forensic accountants are often called upon in legal disputes, be it family law matters, business divorces, or shareholder disputes, to trace assets, value businesses, or reconstruct financial histories. Fraud investigations. As cyber fraud and internal theft increases, businesses are relying on forensic experts to identify irregularities, quantify losses, and support insurance claims or criminal prosecutions. And lastly, insolvency matters. Liquidators and administrators may engage forensic specialists to uncover improper transactions or Phoenix activity prior to a collapse. What's driving the demand? Increased financial complexity. As business structures become more layered and transactions move online, understanding financial truth requires more than just a glance at the general ledger. Litigation pressure. Courts demand evidentiary rigor, and legal terms often need independent, credible financial testimony to support or refute claims. Regulatory scrutiny. ASIC, the ATO, and other regulators have intensified their pursuit of misconduct. Forensic accountants often assist with investigations and reports. For business owners, the takeaway is clear. Robust internal controls, transparency, and detailed record keeping are no longer optional. And when disputes arise, involving a forensic expert early can mitigate financial and reputational risk. What does this mean for you? Even if you're not involved in litigation, forensic accounting has preventative value. Internal audits, fraud risk assessments, and forensic reviews can highlight vulnerabilities before they become crises. Professionals across law, finance, and business strategy are increasingly collaborating with forensic specialists, not just in courtrooms, but in boardrooms. So while it may have once been niche, forensic accounting is now a frontline tool for protecting value, maintaining trust, and navigating Australia's increasingly litigious and complex business environment. Thank you for taking the time to listen to today's edition of Money Mavericks. I look forward to speaking to you in the next fortnight.